Imagine you own a building where the cheapest thing on the floor costs $80,000, where the product gleams under showroom lighting and turns heads before anyone checks the price, where customers arrive already convinced they deserve this, and your job is simply to confirm it. There are approximately 18,000 franchised car dealerships in the United States today. A luxury dealership carrying a brand like Porsche or Mercedes-Benz or BMW can move anywhere from 300 to 1,500 vehicles per year. At an average transaction price of $90,000, that is between $27 million and $135 million in gross vehicle sales from a single location annually. Those are numbers that sound like a very good business, and in some years and in some markets they are. But the economics underneath those numbers are structured in a way that surprises almost everyone who looks at them closely. The average new car gross profit margin at a franchised dealership runs between 1 and 3% of the vehicle sale price. On a $90,000 Mercedes, that is between $900 and $2,700 in gross profit on the vehicle itself. And that is before a single dollar of overhead is paid. Rent on a luxury dealership facility in a primary market runs between $50,000 and $200,000 per month. The sales staff commission on that same vehicle can consume a significant portion of whatever gross margin remains. And the manufacturer controls your inventory, allocation, your pricing floor, your facility standards, and your right to operate at all. You do not own the franchise in the way most people think about ownership. You hold a license that can be reviewed, renegotiated, and in certain circumstances revoked. So if the money is not in the car and the manufacturer controls the terms, then where does a luxury dealership actually make its profit? The answer is in three places that most customers never think about, and that the industry has spent decades making as invisible as possible. Here is the economics of owning a luxury car dealership. Let's start with what it costs to open a luxury car dealership before a single vehicle is sold. The first requirement is the franchise agreement itself. And obtaining one from a luxury manufacturer is not simply a matter of applying and writing a check. BMW, Mercedes-Benz, Porsche, and Audi each maintain strict criteria for who they will grant a franchise to, where that franchise can operate, and what physical standards the facility must meet before the brand will allow its name above the door. The facility requirement alone is where most aspiring dealers underestimate the investment. A new luxury dealership facility built to manufacturer standards costs between $5 million and $30 million depending on brand, location, and size. Porsche has one of the most demanding facility programs in the industry. Its dealership design standards require specific architectural elements, lighting systems, display configurations, and customer lounge specifications that are non-negotiable. If you acquire an existing dealership rather than building from scratch, the purchase price includes not just the real estate and the building, but the franchise point itself, the right to operate that brand in that market. A well-located BMW or Mercedes dealership in a major metropolitan market can carry a blue sky value, the intangible value of the franchise point above and beyond physical assets, of $5 million to $20 million or more. Then there is the floor plan. Floor plan financing is the mechanism by which dealers fund their vehicle inventory, and understanding it is fundamental to understanding dealership economics. A dealer does not pay cash for the vehicles sitting on their lot. They borrow against each vehicle individually through a line of credit provided by the manufacturer's captive finance arm, BMW Financial Services, Mercedes-Benz Financial, Porsche Financial Services. Each vehicle on the lot represents a borrowed amount that accrues interest daily from the moment it arrives at the dealership. A luxury dealership carrying 150 vehicles at an average cost of $80,000 each has $12 million in floor plan debt outstanding at any given moment. At a floor plan interest rate of 6 to 8%, that is between $720,000 and $960,000 in annual interest expense, simply to maintain the inventory that makes the showroom look full. And that interest clock runs whether the cars are selling or sitting. Here is the truth about new car margins that the industry would prefer customers never fully understood. The manufacturer sets a manufacturer's suggested retail price, the MSRP, and the dealer pays the manufacturer an invoice price that sits below it. The difference between invoice and MSRP is called the front-end gross, and on a luxury vehicle, it typically runs between 2 and 8% of MSRP. On a $100,000 Porsche, that front-end gross might be $4,000 to $8,000 before any negotiation with the customer. But here's where it gets complicated. Customers negotiate. In a normal market, a motivated customer can negotiate a luxury vehicle to invoice or even below invoice, which appears to eliminate the dealer's margin entirely. Below invoice sales are possible because of a mechanism called holdback. Holdback is a percentage of MSRP, typically 2 to 3%, that the manufacturer pays back to the dealer after the vehicle is sold, regardless of what price the customer paid. On a $100,000 vehicle, holdback might be $2,000 to $3,000 paid directly from the manufacturer to the dealer after the sale closes. This is why dealers can advertise invoice pricing and still remain in business, because the true cost of the vehicle to the dealer is below invoice once holdback is factored in. Then there are manufacturer incentives, volume bonuses paid to dealers who hit monthly or quarterly sales targets set by the manufacturer. A dealer who sells 50 vehicles in a month when the manufacturer's target is 45 receives a per-unit bonus on all 50 vehicles sold that month, not just the incremental 5. This creates a powerful incentive to move metal at the end of the month regardless of margin, because the volume bonus can be worth more than the front-end gross on every vehicle combined. The result is a new car business where the stated margin is thin, the negotiated margin is thinner, and the real economics depend on back-end payments from the manufacturer that customers never see and rarely know exist. If new car margins are thin, the used car operation is where a well-run luxury dealership makes serious money. The used car market operates on entirely different economics from the new car business. There is no manufacturer invoice price. There is no holdback. There is no MSRP that a customer can look up online and use as a negotiating anchor. The dealer acquires used vehicles through trade-ins, customer purchases, and wholesale auctions, and prices them based on market data and their own judgment about what the local market will bear. A certified pre-owned BMW acquired at auction for $45,000 might be retailed at $54,000. Representing a $9,000 front-end gross that dwarfs anything available on a new vehicle transaction. The gross margin percentage on used luxury vehicles routinely runs between 8 and 15% of the sale price, 3 to 5 times the margin available on new vehicles. This is why every experienced dealer measures their used car operation with intense focus. The ratio of used vehicles sold to new vehicles sold, the used-to-new ratio, is one of the most watched metrics in dealership management. A dealer selling one used vehicle for every new vehicle sold is considered to be performing adequately. A dealer selling 2 used vehicles for every new vehicle sold is operating a genuinely profitable business. The challenge of the used car operation is inventory acquisition and pricing discipline. Trade-in valuations are the moment where dealer profit is most directly determined. Because the price paid for a trade-in at the front of a transaction directly determines the margin available at the back. A dealer who consistently overpays for trade-ins to close new car deals is subsidizing new car volume with used car margin, a trade-off that erodes profitability faster than almost any other operational mistake. Here's the part of the dealership that generates more profit per transaction than any other, and that most customers experience as a brief, uncomfortable administrative formality at the end of a long day. The finance and insurance office, the F&I office, is where the customer sits across from the finance manager after agreeing on a vehicle price and completes the paperwork to finalize the purchase. In the 30 to 60 minutes that transaction takes, the finance manager has the opportunity to present a menu of additional products. Extended warranties, also called vehicle service contracts, are the most significant F&I product by revenue. A luxury vehicle service contract covering mechanical breakdown beyond the manufacturer's warranty period might retail for $3,000 to $6,000. The dealer's cost for that contract from the administrator who underwrites it might be $800 to $1,500. The gross profit on a single service contract sale is often larger than the entire front-end gross on the vehicle itself. Then there is gap insurance, guaranteed asset protection, which covers the difference between what a customer owes on a vehicle and what their insurance pays out if the vehicle is totaled. On a luxury vehicle financed at full value, gap insurance retails for $500 to $1,000 with a dealer cost of $100 to $200. Then there are paint protection films, ceramic coatings, wheel and tire protection plans, key replacement programs, and prepaid maintenance packages, each carrying gross margins of 60 to 80%. A skilled finance manager working a luxury dealership can generate $2,000 to $5,000 in F&I gross profit per vehicle retailed. On a dealership selling 600 vehicles per year, that is between $1.2 million and $3 million in F&I gross profit annually from a single office with 1 or 2 employees. The F&I office is the highest margin, highest revenue per employee operation in the entire dealership. It is also the most regulated, subject to Truth in Lending Act requirements, state insurance licensing laws, and FTC oversight, and the source of more consumer complaints and legal exposure than any other part of the business. If F&I is the most profitable room in the building, the service department is the most important business in the dealership for long-term survival. A luxury vehicle service department generates revenue in 2 primary ways. Warranty work, repairs covered by the manufacturer's warranty and reimbursed to the dealer at a negotiated labor rate, provides a steady baseline of traffic and revenue regardless of new car sales volume. Customer pay work, repairs and maintenance that the customer pays for directly, generates significantly higher margins than warranty work because the dealer sets the labor rate rather than accepting the manufacturer's reimbursement rate. A luxury dealership service department charges between $180 and $350 per flat rate hour for customer pay labor depending on brand and market. The technician performing that work is paid a fraction of the billed labor rate, typically between $30 and $80 per hour depending on their certification level and experience. The difference between the billed rate and the technician's cost, multiplied across every repair order written every day, is the service department's labor gross profit. A well-run luxury service department generates labor gross margins of 60 to 70%. Parts gross margins, the markup on components used in repairs, add another layer of profitability with typical margins running between 30 and 50% of the part's retail price. A luxury dealership service department generating $8 million in annual revenue at a combined gross margin of 55% produces $4.4 million in gross profit from the service operation alone. That figure is often larger than the combined gross profit from new and used vehicle sales. And unlike vehicle sales, which are transactional and cyclical and dependent on consumer confidence and credit availability, service revenue is recurring, predictable, and largely recession-resistant. People continue to service their vehicles even when they stop buying new ones. This is why the most sophisticated dealer groups evaluate acquisitions primarily on the strength and potential of the service department rather than the showroom volume. Let's talk about the relationship that defines everything else in this business. The franchise agreement between a luxury dealer and their manufacturer is one of the most asymmetric commercial relationships in American business. The manufacturer determines which vehicles the dealer receives and in what quantities, and that allocation decision directly determines what the dealer can sell. During periods of vehicle scarcity, and as experienced across the industry during the semiconductor shortage of 2021 and 2022, dealers with strong manufacturer relationships received preferential allocation while others waited months for inventory. The manufacturer sets the standards that the dealer's facility must meet, and those standards evolve on a cycle that requires dealers to invest in facility upgrades whether or not the economics of their market justify the capital expenditure. BMW's dealer facility program has required multi-million-dollar renovations at dealerships across the country on a rolling basis. Investments the dealer must make to retain the franchise regardless of their local market conditions. The manufacturer controls the certified pre-owned program. The criteria vehicles must meet to carry the CPO designation, and the warranty backing that makes CPO vehicles worth a premium to consumers. The manufacturer controls the warranty reimbursement rates, the labor rates, and parts markups they will pay for warranty repairs, through a negotiation process in which the dealer has limited leverage. And the manufacturer controls the customer satisfaction survey process, the scores from which directly impact a dealer's bonus eligibility and, in some cases, their allocation standing. A dealer who receives poor customer satisfaction scores, even for reasons partially outside their control, can lose eligibility for manufacturer volume bonuses worth hundreds of thousands of dollars annually. The franchise agreement can be terminated for cause, defined by the manufacturer, and while state franchise laws provide dealers with significant protections, the process of defending a franchise termination is expensive, protracted, and uncertain in outcome. This is the fundamental tension at the heart of luxury dealership ownership. You have invested tens of millions of dollars in a business whose most critical inputs, inventory pricing standards and brand reputation, are controlled by an entity whose interests are aligned with yours in good times and diverge sharply from yours the moment the market turns. So does owning a luxury car dealership actually work as a business? The honest answer is, it depends entirely on your market, your manufacturer relationship, and whether you understand where the money actually comes from. If you are operating in a supply-constrained market with strong demographic tailwinds, a well-located luxury dealership is one of the most cash-generative businesses available to a private operator. The combination of F&I income service department profitability, used car margin, and manufacturer volume bonuses can produce operating margins that significantly exceed what the thin new car margins would suggest is possible. The publicly traded dealer groups, AutoNation, Penske Automotive, Lithia Motors, and Asbury Automotive, have consistently demonstrated that scaled luxury dealership operations generate returns that justify the capital intensity of the business. Penske Automotive Group generated $29.6 billion in revenue in 2023, with a significant concentration in premium and luxury brands. Asbury Automotive's luxury and import brand mix generates above-average F&I income and service retention that supports margins well above the industry average. In the realistic bad scenario, you are operating a single-point luxury dealership in a market that just absorbed a new competing franchise 2 miles away. Your new car allocation has been reduced by the manufacturer to reflect your declining market share. Your best finance manager just left for a competing store at a higher guaranteed draw. Your facility upgrade requirement from the manufacturer is due in 18 months at a projected cost of $4 million. And the used car market has softened enough that the vehicles you acquired at peak auction prices 3 months ago are now retailing below your cost of acquisition. The floor plan interest on your $12 million inventory is running at $80,000 per month. And the manufacturer's customer satisfaction survey results from last quarter have made you ineligible for the volume bonus you had budgeted for,